So, good morning, friends. Today we are going to talk about fundraising by startups, which is very important topic for all of us. And we are going to look at equity versus compulsory convertible preference shares, uh, mm, and that is called CCPS. So, let us look at what how CCPS is better than equity, and also vis-a-vis other instruments which are available in the market. So we are going to have a quick look at all of them, and then we can have a interaction as to which one is better for startups. Now, if you look at the funding options, right? One, of course, is the straightaway equity share capital, which is plain vanilla thing. Okay, you are offering equity to someone at a particular valuation. Then comes the compulsory convertible preference shares, which are CCPS, um, which is basically the you kind of convert these shares into equity at a later stage and at a very defined stage, right? And of course, there are compulsory convertible debentures as well, which are called CCDs. Then, of course, shareholder loan and other debentures, which are uh, you know there are shareholder loans, and you can see my screen, right? You guys can see my screen.
Yes, yes, we can.
Yeah, yeah, yeah. Okay. So there are shareholder loans, other debentures, redeemable or optional convertible debentures, and of course other preference shares, redeemable, optionally convertible, and of course a mix of all above can be you know utilized by uh, the one who is going for the funding option. Now let us look at what are the key drivers for choice of funding option. One, of course, uh, most of the times it is foreign funding coming in. So Indian exchange control regulation and other regulatory requirements are important for us to look at. So this is one area where we need to focus on, and we must be not caught on the wrong side of the law as far as FEMA rules are concerned and other regulations are concerned. Then, of course, Indian company law regulations, Companies Act 2013 covers most of the things which are required to be done when the whether equity is being allocated, or even debentures or convertible preference shares are allocated. So at that time, this needs to be managed. Then, of course, the tax efficiency, which is very important for all of us, because how efficient this structure is for the taxation purposes, that is also something very important component for us to judge. And the ease of repatriation, because at the end of the day, uh, every investor is looking for uh, the money to go back to them. No? So the ease of repatriation is also something they are looking at all the time. So this is again a very important component for everyone to look at. And the other commercial considerations like voting right, control. So these are the various factors which are normally very important for everyone who is investing into the company, or even for us who are actually receiving the capital. These are the factors to be considered. Now, what is CCPS? I think many people they are not still very clear how this CCPS works, and equity everybody knows, but that is why I thought let me um, try and talk more about CCPS. So, compulsory convertible preference shares, they are uh, now preferred investment instrument for high net worth and PE investors. and they bridge the gap in mismatch in valuation expectation between investor and the promoter. Uh, of course, they are financial instruments which are superior to the equity shares in relation to dividend and recovery at liquidation of the event. And of course, they are compulsory convertible into equity either at a given point of time or at happening of certain events. So you can either say my compulsory convertible equity shares are going to convert say after 2 years or 3 years, or when I receive my Series A capital or Series B, or you can even define the stages at which stage my convertibility is going to happen. And as and when we reach that stage, we can go ahead with the conversion part. So it's a very flexible instrument and very excellent instrument because it gives you leeway for managing your valuation the way you want. Because at the end of the day, I think it is all about how you are managing the valuations. So that part we need to manage perfectly. So CCPS that way helps that okay, at this moment you are giving me this much fund, but mm, I will convert this at a particular valuation maybe 2 years later, and it can be a discounted valuation vis-a-vis the the valuation which is available at that point of time. So you know that is how uh, the person who is managing this CCPS, they can actually utilize the funds, and they can look at the convertibility part, manage according to the needs of the company. And once the CCPS gets converted, there is no obligation on the part of the company to redeem them since they are no longer preference shares. So preference share itself has preferred treatment. So at the time of insolvency or at the time of exit, uh, there are certain strings attached to the preference shares. That is why they are called preference shares. So I think all of us we need to understand this part in detail, and I think as we go by, we will be talking more about it. Now, what are the features of CCPS? Um, One, they do not carry voting right until conversion into equity shares. We all know equity shareholders have equal voting rights, right? So, as the person is allocated some equity shares, they are, uh, they can vote. So, when the resolutions have to be passed, suppose there is a special resolution to be passed, so we need 75% people must agree to it. No? So, in case of CCPS, this may not happen, right? So, because they don't have voting right unless the conversion is done into the equity part. So that is a beauty of it. So the person or the company which is issuing CCPS, they have an advantage that they don't have to worry about passing the resolutions unless so it is always better strategy that because in initial stages of your business you need more of the flexibility for passing the resolutions and taking bigger decisions. So when you are issuing CCPS, at least the voting rights remain with you. So that is the biggest advantage of issuing CCPS. Uh, then, of course, this is an advantage for the person who is receiving CCPS because you have to sell out that idea also. And basically, this is, they get priority for the dividends. So that is again something which all of us are aware of that when the dividends are being considered, so first preference is given to the CCPS holders or preference shareholders, right? So, so that is the selling point for uh, making them agree to CCPS. Then they get preference in recovery at liquidation event, as I mentioned, that in case the company goes into liquidation or the company faces some tough situation, so they can actually get preference. So they will be settled first. So, for example, we all know that in the at the time of liquidation, what happens? Whatever assets a company has, they are valued and in cash, and that is distributed to all the shareholders. Or the first creditors are settled, then preference shareholders are settled, and then comes the equity shareholder. So there is a preference which is available to the for at the time of recovery or liquidation event. Allow its holders to convert it into equity shares at a future predetermined conversion price or conversion formula. So this is again all already it's fixed that okay, this is the time, this we will do it at this valuation, the conversion, or we will do it at this kind of a conversion formula. So that can be part of the CCPS issuance document, and you can actually peg that so that there is no confusion at the time of conversion. So that is very much clear to the investor also, that I'm going to get these many shares at this conversion price. Then, at the time of issue of CCPS, the conversion ratio or conversion formula, uh, is to be decided upfront, as we mentioned. So, these are the features of CCPS. Now, let us look at how they compare with the equity shares. Um, uh, so till now, whatever we have discussed, uh, if you look at the voting rights, yes, equity shares have voting rights, but CCPS, they do not have voting rights. If you look at the dividend part, uh, the only after preference shares are issued, uh, then the dividend you know, uh, will be there. And CCPS, of course, has superior rights for dividend. Control on dilution, it's upfront on conversion. And liquidity preference, of course, there's no liquidity preference, but it is there for CCPS. And investor role, of course, they are both owners of the company, because for CCPS also, ultimately conversion will happen. So that's the beauty of it, that you get the ownership, but you can actually delay that by certain period or certain extent, so that at the happening of certain events, after that you can give the conversion to the CCPS holders.
I have
Now,
question there, sir.
yeah, yeah, sure.
Can I?
Yeah,
Can you please point out that liquidity preferences? So when you say the CCPs have liquidity preferences, are they on participatory mode or only on the borrowed fund?
no, no, no. See, CCPS is going to be converted into equity at a later stage, right? So the liquidity preference, when I say, is basically that at the time of exit, or if suppose there is a company goes into liquidation, or any such unfortunate event is there, so they will be having preferred treatment, right? So CCPS guys will be settled first, and then comes the turn of equity guys. So that is the
Yeah, when they say be settled, do they mean the settled only on the borrowed fund or on the assets, whatever, on a proportionate note of the total
on,
assets?
yes, proportionate note of the total assets. And of course, after settling the creditors, then whatever is left, that first will be the CCPS guys will be settled, and then of course the equity, of course, will be settled.
Okay, so they're participatory in the
Yes,
liquidation.
yes, yes, absolutely.
Thank you.
Any other question so far? I hope I'm not going too fast. So now let us look at the CCPS benefits. Uh, you know, the founders of the company, they keep their stake intact when the company issue equity shares to new investors. Now this is the biggest benefit for the startup, because sometimes you don't want to dilute your equity percentages so much in the initial stages. So this is a route available to the promoters, that they can actually uh, by issuing CCPS, they are not actually diluting their liquidity. So, diluting their equity percentage. So, the promoters may convert their CCPS, which was taken at the time at lower valuation, and when new investors bring in money at a higher valuation, the promoters can increase their stake by bringing money at higher valuation. So that is how it's CCPS gives you a breather, that okay, you wait for some time, and your because when you have money, you tend to perform better, your revenues go up, your profitability goes up, and once your profitability and revenue increase, definitely your valuation accordingly goes up. So you are able to uh, you know offer less percentage of equity to the holders, and at the time of conversion you can control, and you can have a better control on the company if you are following the CCPS route. Because if you are just following the equity route, uh, your equity is already diluted right at that point of time. But in case of CCPS, it is being done at a later date, so you have a room for managing that part, right? Then CCPS is a preferred financing tool for startups. Why? Because convertible instrument has become a common financing tool, especially for the entrepreneurs looking to fund startups. This we are all clear about. In case of startups, majority of investments are coming in the form of convertible instruments, because these days a lot of structuring is required when you actually go ahead with your startup funding. So this is a one tool which is available for us to structure our uh, you know overall equity, and the cap table management becomes much more easier, because otherwise, if you straight away issue equity, you end up having lesser stake in the company in the initial stage itself. So that is why it is a preferred instrument for the startups. But if you look at the investor also, from their standpoint also, they have a better uh, you know safety of your money, because your dividend can be fixed. In case of CCPS, they can say that okay, it is a 6% CCPS, 10% CCPS. That means uh, some fixed percentage of dividend has to be given to them, or people are issuing 5%, 6% also. So like that, they can have a fixed dividend, and the option of converting that into equity at a later stage. So it's a win-win situation for the startups also, who are and for the investors also. So regulatory framework, if we look at one Companies Act, uh, govern the provisions with regard to CCPS. Then, of course, Income Tax Act 1961 talks about for capital gain and other income aspects for CCPS. We need to look at that. And then FEMA, as I mentioned, for the FDI route. And now most of it we have discussed already, but just to summarize and make us all understand what are the benefits for the promoters and investors. One, benefit we can clearly make out is no sharing of voting rights until conversion. So that's a very, very big benefit for the promoters because uh, you don't lose control over your company in the initial stages. Because if suppose you are uh, already offering 30%, 40% equity to someone at the initial stage itself, that means you are not having full control over your company. But in case of CCPS, you can keep the control with yourself, and later on, of course, you can you know dilute your equity. I was looking at the equity structure of HDFC and HDFC Bank, and I also saw a kind of an interview of Mr. Deepak Parekh. So I think Mr. Parekh holds less than 1% or around 1% equity, in HDFC. So somebody asked him, why you on such a less percentage, or even your father could have. He said, we were all professionals working for the bank, so they actually so that's an example of a company which is professionally managed and is being controlled by the all other shareholders, but run by a professional, right? So that is how one can think of, but that is a extreme example, of a person holding just 1%. But otherwise, it is always advisable that at least you keep more than 50% or 51% equity with you know you yourself or your co-promoter, uh, so to say, so that at least all major decisions regarding the company can be taken by you. Otherwise, in the era of shareholder democracy, sometimes it is very difficult to have that kind of control. So and you cannot pass resolutions, and if you are not able to pass resolutions, you can't take major decisions. So that is something which we have to be very clear about. So that is where the CCPS plays a very positive role in giving you that leeway and managing your uh, cap table. No? So then, of course, fixing of the conversion price. So conversion ratio and conversion formula may be decided as we discussed, considering the growth plan of the startup. So if you know that, okay, I'm going to grow, my revenue will be say double or three times in 1 year, and maybe it will grow at a tremendous pace in 2 years, and that will lead my valuation to change from the present position to maybe 5x or 10x in the times to come. So it is always sensible to issue CCPS so that you are in control of the situation till the time your money is coming into the system, and you are actually rotating that to generate more value for the company. And when the value is and you can keep a clause that, okay, CCPS will be converted at this stage at the valuation which is prevailing at that time. No? So and maybe you can even say, okay, at a discounted price from the valuation which is there at that time. So so little bit of discount, but that will be still much lesser than what you may be offering to uh, if you issue equity right away. So that is where I think the promoters, they need to plan their according to the growth pattern of their organization. They can plan for CCPS. Then, of course, raising funds at better terms. This is again a very big win-win situation for the promoters, because equity shares are generally issued at par, uh, whereas the convertible shares, you can raise funds at a better terms and conditions, and you can vary the terms for different class of CCPS also. For example, you bring, okay, CCPS round 1, CCPS round 2, round 3. So it can be at a various percentages and various valuation levels also. So that is again, I'm sure a lot of merchant bankers, they have these kind of tricks up their sleeve to help the startups to achieve the better, you know, in the terms of CCPS, better terms are there for the promoters. And let us look at what are the benefits for investors. Of course, they can plan their conversion in line with the company's performance and growth. So again, it's another kind of a win-win for them. Then, of course, there are anti-dilution clauses. Uh, in term sheet, investor can ask anti-dilution provision to shield from their investment potentially losing value. So, this is again something which is beneficial for the investor, because if they this kind of a anti-dilution clause is there, so they can uh, keep the value of the investment intact, and but equity shareholders, they can even lose their money. So this is a kind of a safety net for the investor also, if they opt for CCPS. And the reservation of corporate benefits, of course, they are entitled for corporate benefits like dividend, bonus issue in proportion of their holding in the company. So they get all those benefits which are there, available to the equity holders, but at the same time, uh, they have a safety net around their money. So this is the benefit for the investors. Now let us look at the income tax aspects. One, there is a tax on premium. So Section 56(2) of the Income Tax Act, um, re- along with the rules, they talk about the premium received by the company in excess of fair market value is chargeable under the head income from other sources. So so this is one angle, uh, which you know so you delay your taxation of the premium, right? So this is one part of it. And then the CCPS valuation is required under Section 56 to 7B of the Income Tax Act. And according to that, it can be at net book value method or discounted cash flow method. So both these methods can be used for managing your valuation for the CCPS. Now,
I have a question
yeah,
here.
yeah.
Uh, if the equity shares are at a face value of 10,
Mhm.
should we issue the CCPS at the face value, or should it be, can we issue it more than the price?
No, no, CCPS will not be at the face value of 10. They will be converted into equity later, right? So CCPS can be at a face value which is different from the equity face value. That's not a problem.
So,
But but
do we need to?
when they will be converted, that time they will be converted into the equity at that face value at which equity is being considered.
Okay, then do we need to pay the tax when we are saying that as a company should we pay tax for the premium that we are paying for the preference shares?
The premium. So that is the beauty of it. You can even structure your CCPS in such a way that premium is kept little less at that time. No, but uh, uh, but then the taxation will happen. You can delay or defer the tax by playing around with the. But when suppose at the time when the conversion will happen to equity, at that time the premium will become taxable. So that's the so you can delay the premium to some extent. while planning the CCPS.
Okay.
Yeah.
Thank you.
Yeah. So capital gain on conversion of CCPS into equity. Now, this again is Mumbai bench. This came before that, and they mentioned that in case the conversion of CCPS into equity, uh, it is not a transfer. No, it is a conversion. So conversion means it is getting converted into equity shares. So no capital gain is you know levied at the time of conversion. So this is again it was a contentious issue. Some income tax authorities went against a company that okay, at the time when you are converting your CCPS into equity, you should pay capital gain tax. So it was held by Mumbai bench that it is basically a conversion. It is not something event which can trigger capital gain because it's not a transfer. So, so this is again very clear. FEMA aspects, as per FEMA, provisions of RBI circular for receiving the foreign investments in the form of CCPS shall be recognized as equity instrument treated as FTI. No? So we will look at the various FEMA provisions. There is a I did out this comparative analysis. Uh, if you look at the parameters, this is mainly from FTI perspective, right? So the kind of money which when they come in, uh, say from foreign equity, this is not considering the Indian equity. If you look at it is treated as FDI in case of equity shares. In case of CCPS also, it will be considered as FDI. Suppose you issue CCD, as we discussed in the first slide, cumulative convertible debentures. So that also will be considered as FDI. But in case of shareholder loan or other kind of debentures, it will be considered as ECB. We all know about external commercial borrowings, right? So borrowings are always different from the equity, and the other preference shares, if you are issuing, that is also will be treated as a ECB. So this is how, from this chart, we can understand very clearly how the treatment of the money will be done uh, in case of FEMA. Now, restrictions on amount, there's no restriction in case of equity as well as CCPS or as well as CCD. Government of India is very much open to the idea of money flowing into Indian startups, and they are very flexible. FEMA provisions are also very open now, um, and they have really eased out a lot of restrictions which were there earlier, and now things have changed a lot, right? So end use restrictions are not applicable in case of equity, CCPS or CCD. But of course, in case of shareholder loans or preference shares, there are certain restrictions. They cannot be used for lending, investment in capital market, acquiring company in India or part thereof, real estate, working capital or general corporate purpose, and repayment of existing rupee loans. So these are the restrictions only from the loan perspective or debentures or other preference shares if they are being issued. But in case of equity, CCPS and CCD, no restrictions are applicable, right? So in case of a permitted lenders, again, there are uh, you know no restrictions as far as equity, CCPS and CCD are concerned, and uh, but in case of a shareholder loan or other debenture, equity shareholder holding 25% of equity shares directly, they can only give shareholder loans, or uh, they can be issued debentures and other preference shares. Now, if you look at the cost, equity, nothing is specified. Uh, but in case of a CCPS, there is a cap on maximum dividend, which is SBI PLR plus 300 basis points. So this is just to make sure that too much of high rated CCPS are not issued, so that government is of course always trying to make sure that excessive uh, you know money should not flow out of India. So from that perspective, they have kept a cap on CCPS, and also in case of a CCD, there's no specific instruction, but uh, but it is said that it should not exceed the prescribed CCPS coupon rate in case of CCD also. So that is a kind of benchmark which is there. Uh, and there are, of course, some benchmarks in case of shareholder loan and other preference shares. So, idea is to cap the cost of the instruments so that there is no excessive drain of money out of India. Instead of the provisions for Indian FEMA is very open. If you are bringing money into India, of course you have to explain from where the money is coming. But inward traffic is always welcome. No? But um, of course, FDI, there are a lot of restrictions, and they are now kind of monitoring, especially the money which is uh, coming from certain countries who are trying to invest heavily into India. So that part is also government has come out with certain restrictions. Even in the Companies Act, certain amendments have been brought where if the money is coming from the countries which are bordering India, no, now countries which are bordering India are China, uh, Myanmar, the Bangladesh, like that, Pakistan. So if the money is coming from any of the countries which is bordering India, then there are certain specific restrictions, and there are certain disclosures to be made. Even the director, if a director is coming from any of these countries, there is a special approval of the Ministry of Home Affairs required. So that way, now Indian government has become very cautious on money being flowing into India, and they don't want Sri Lanka kind of example to happen in India. So they are very much cautious of managing this flow of money which is coming into India. But at the end of the day, still they are very flexible in terms of money coming into startups and genuine money flowing into the system. And of course, the right of dividend and interest, if you can look at, it can be paid only from uh, profit after tax and after payment of the preference dividend. In case of a CCPS, right to receive dividend over equity shares can be paid out of the PAT, which is very much clear. And in case of a CCD, interest can be paid irrespective of the availability of the profits. Of course, in the case of a shareholder loan, interest can be paid irrespective of the availability of the profit, because it is a cost. Because if you are, it's like a borrowing money only, right? So if you are taking money as a loan, the interest can be paid. And in case of other preference shares, right to receive dividend over equity shares can be paid out of PAT. Uh, I think all of us are clear about that. Then tax on deductibility of dividend and interest. Equity dividend not deductible for tax purpose, and whereas in case of a CCPS also preference dividend is not deductible for tax purpose, uh, but in case of a CCD, interest is a tax deductible subject to appropriate of withholding tax, uh, which is very much different from that is how the CCPS and CCD are a little bit different, and the interest, of course, is tax deductible. Subject to withholding tax in case of a shareholder loan or other debentures, and also in case of preference dividend, uh, uh, it is not deductible for tax purpose. So these are the comparatives between equity shares, CCPS, CCD, and the loans and preference shares. Now, if you look at voting rights, of course, we discussed for equity shares and CCPS. In case of equity shares, it is available. In case of CCPS, uh, it is available if dividend is not paid for 2 years or post conversion, of course. And in case of a CCD, it is available post conversion into equity shares. And in case of a shareholder loan or other debentures, not available except for part converted into equity shares. Suppose at some stage it is getting converted, so after that only it is available. And similar situation is there for other preference shares. So I hope this is making things much clearer to you as to how uh, all these instruments are different from each other. Now, in
I have one question.
yeah,
When you say
sure,
these other preference shares,
yeah,
are these redeemable preference shares, no? That are issued.
yes, yes,
At-
they can be redeemable, they can be not redeemable, both,
and can they get a premium
but they are not
during?
convertible. The difference is they are not convertible. If they are convertible, then it becomes CCPS.
Okay, but can they get a premium during redemption? And is there any standard percentage for premium
No,
of?
premium is not. They are the whatever is the face value, at that face value only they'll be redeemed, but they will definitely get preference over the other. If suppose they are just like a debt, right? So so they will be getting same treatment as a person who is lending, so like a banker or something, right? So that I think will clarify to you. So they'll be treated as par with the lenders to the company.
Okay, thank you.
So now, if you look at the other parameters, prepayment of or repatriation of and minimum time or period for redemption. Uh, the repatriation in case of equity shares can be done through buyback or capital reduction. In case of CCPS, it is possible post conversion into equity shares, and maximum time period is 20 years from the date of issue. In case of a CCD, it is possible post conversion into equity shares, and no time limit is there for CCD in a private company. Similarly, for shareholder loans or others, uh, you know, there are different caps which are there up to 20 million USD or more than 20 million USD. So they are treated in a different way in FEMA as per the regulation which will be prevailing at that point of time, right? So that but as far as the repatriation through buyback or capital reduction, that is the prevalent procedure for equity shares. Now, the applicability of Indian transfer pricing regulation. Now, this is also very important because transfer pricing is a very uh, mm, uh, you know different subject, and the if in transfer pricing authorities. They look at the money, whether the money is flowing out of India in a different way, so that so so in case of equity shares, it is not applicable on dividend payments, and in case of CCPS, it may be applicable on dividend payments, and in case of a CCD, it is applicable on interest payments, right? So in case of a shareholder loan, again, it is applicable on interest payments, and in case of other preference shares, it may be applicable on dividend payments. So that's how the applicability of transfer pricing regulations will be there, and the transfer pricing officer will look at it whether on a particular transaction the applicability is there or not, and only then they will do the assessment, right? And Let us look at the taxation on conversion. In case of equity shares, it's not applicable. Um, mm, and similarly, CCPS also may not be held as taxable. And in case of a CCD, it is exempt. In case of a, shareholder loans, not applicable. Debentures, of course, it will be exempt, and for other preference shares may not be held as taxable. And taxation on exits, if we look at the in case of equity shares, it is subject to capital gain tax unless structured through a jurisdiction which is favorable, or there is a tax treaty with the that country. And In case of a CCPS, it is subject to capital gain tax, unless again, you know, there is a tax treaty with that particular country. Uh, in case of a CCD, it is uh, subject to capital gain tax, and in case of a shareholder loan, it's not applicable, and for debentures, uh, again, depends on the tax treaty. So I think this must have given you a very complete analysis and idea about how equity shares, CCPS, and CCDs are different, and how loans and other preference shares are entirely different, and their tax treatment and everything is different for the companies. And let me tell you, it is very, very important for all of us to understand um, the different laws of the land, and structure our cap table in such a way that we don't end up taking wrong calls and wrong decisions of offering our equity at a very lower value. Also, because at the end of the day, the control, or the uh, you know money you have is in the company itself, and that lies with the perfect valuation and the perfect time of one allotting the shares, and also perfect time of converting these shares if you are issuing CCPS. So I think I wanted to share this with all of you, so that all of us are aware, and we take a conscious decision and take a perfect call, and don't get you know undervalue, or under we oversell ourselves. Sometimes the deal look very lucrative, that okay, person is offering us say 1 million USD, and they are looking for 30% equity, 40% equity, but you have to really think about it as to where your company can lead in terms of valuation, um, and what kind of traction you are going to get, and how much big you can be, and then accordingly take a call whether to issue equity shares, or go for CCPS route, or go for CCD route for that matter. But I think the choice between equity and CCPS, if you ask me honestly, CCPS really stands out. So we must uh, take a professional help. And if you have a existing merchant banker, fine. Otherwise, do approach a professional who can guide you properly on how to structure your offering to the public and to the investors. So there's a lot of action happening in the startup space these days. So I thought this is the right topic for all of us to look at. Uh, so I now invite more questions. Anybody with any doubts about it?
When can the investors transfer the shares without company's knowledge?
No, no. The transfer has to come to company only, right? So I mean, the registration of transfer will happen with the company. They can offer shares to someone, uh, but when they are going to come, unless it is I'm sure the question is regarding private limited company only, right?
Yeah.
So the registration of the transfer will come to company only, right?
Okay.
Anybody else?
Raju, thank you for covering a detailed information on CCPS.
Yeah.
Uh, I just want to check with you. There is a one point to be added on over there. When it is being given as a discounted rate,
Mm-hmm.
like 20 percentage or whatever it is within the next 2 years of the time, when
Right.
once CCPS has been offered.
Right.
What my understanding is, they are just going to, for the CCPS, there are two main factors are there. One is your time period. They will
Mm-hmm.
be just defining the time period, and
Right.
second thing is you have to show your performance. If your performance is not shown
Right.
during that time period, and that preferential ratio will be changes the equity shares.
Yeah.
Like for example, if they are asking as a one on one, if
Yeah.
you are just offering as a 10 CCPS, then it will become a 20.
Mm-hmm.
So that's what my understanding on this one, because that's the more advantage edge to investor in terms of if company is not performing as expectations
Yeah.
of
So
yes.
so so for investor, as we discussed, the benefit is they can at least be safe about the investment they are doing,
Yeah.
right? So that investment's value is not going to diminish till the time it gets converted into equity, right? So that is one advantage they have. And second, that discounting is basically vis-a-vis the valuation. For example, after 2 years, my valuation is say 700 rupees or something, right? For example, so if I'm offering to CCPS holders say 20% discounted conversion at that time, so that means they will get an advantage. Their conversion price will be 20% less than 700, right? So that's how the structuring is done, and that is where the merchant bank is sorry, that is where the merchant bankers are structuring this deal um, in order to make it attractive for the investors and also attractive for the company, because there's a lot of hidden things where you get a benefit of managing your cap table in much better way uh, till the time conversion happens.
But end of the day, even though if it is not there in the cap table as a displaying as a part of equity, but it is going to be come up, right? You are
Yeah, yeah,
liable to
yeah,
that,
yeah,
right?
yeah,
End
yeah.
of the day, after 2 years, anyway, they are going to be converted. That one.
Absolutely,
You
absolutely.
cannot use that. You cannot leverage that portion of the equity to other investors.
No, no, no. You
Leverage
cannot
it.
you cannot leverage that. But
Only voting rights, yes.
yes,
That's the one.
yes. So that is a very important one, right?
Yeah.
Because in the initial stages, you need to take many bigger calls and tough calls, right? So you have a better control over the company in terms of passing special resolutions and things like that.
Yeah.
Anybody else?
Yeah, sorry, actually my browser hung up. I couldn't
Right. Right.
I had a couple of
Yeah.
thank you so much, Mr. Bajaj. And this is basically the reason why we are here. We are not CFOs and we don't understand this space. And grateful to all the input. When I speak to a lot of American founders or founders who are in India who registered companies abroad and are seeking for funding from abroad, they
Right.
say, "Why do you bother so much about your valuation?
Hmm.
Just ask for a safe note." And I don't understand how the safe note works. I mean, it's almost like you can have an arbitrary valuation and an arbitrary future valuation on the basis of which you're guaranteeing some kind of future valuation for the investor. But I don't understand how this works. What is a safe note, and how is a safe note different from CCPS?
Safe note is basically, kind of uh, future valuation kind of, so um, it's basically a debt kind of a thing only, right? So till the time it is converted into equity, you know. So my take on safe note is if uh, we it is a kind of a convertible instrument, right? So uh, but whether it is again whether a fixed kind of a dividend is being offered or suppose it is say 5% safe note where you are actually so you end up paying 5% fixed amount till the time the conversion happens. So that is I think there are drawbacks. So I won't recommend getting into that safe note thing.
Because every investor, when you talk to them in the angel investor space, or they are in tech investment either out of Bangalore or Silicon Valley,
Yeah. Right.
they say send me a safe contract, and I don't have a safe contract. So they said we'll go through the safe contract and we'll let you know. Because what I've noticed is people, if they have a good idea and they're able to justify that this is the growth from A to B, then they are able to just say that my current valuation is 1 million. I will give you an exit in 3 years at 4 million. Please, I want 10% based on safe note. And according to me, this makes no sense. But people are putting money. They say, this safe note.
These days, people are putting money on metaverse as well.
Yeah.
So yes,
But how do as a non-financial person and a person who doesn't understand what is a safe note and understand this space, how do I participate in this?
actually, Aditya, we can examine what exactly is the offering, and it can be analyzed. So we can definitely discuss that offline. But honestly speaking, to keep the business straight, I think the CCPS is a better route as compared to what we are talking about. So, but yes, we can definitely look at what exactly is the discussion, and maybe that can analyze from financial standpoint how it is better for us.
Thank you.
But there's always a hidden. I was looking at the sanction letter from a banker for uh, you know for some company. So there were so many hidden charges they were keeping. The rate of interest was lower, but at the end of the day, the company, if you utilize the limits, you end up paying this much. If you don't utilize the limit, you also still pay some interest for non-using of the limits. So there are all these smart guys in the financial world. They do some jugglery always, and they leave certain things which are too much hidden inside. So we have to go deeper into what exactly is being talked about.
Which is why most successful entrepreneurs, when they do their second, after they have a successful exit, when they do their second or third venture, they usually have a CA and a lawyer as a partner,
Absolutely. Must
because they,
be.
yeah, because they are as partners, they're fully vested into making sure that the contractual details
Absolutely.
to the company. Yeah.
That is why a lot of companies are from the beginning itself, they are hiring now shared CFOs and the law firms to work with them hand in hand, so that they don't get trapped in any of the contracts or anything they are signing. Yeah. Fine. I think we had a good discussion. So any other questions? Thank you so much, everyone, for joining in today. And I'm sure today's discussion was helpful to you to understand the difference between various instruments which are available for raising the funds. Uh, we we at Startup Change Leaders, we meet every Sunday at 11:30 a.m. So let's continue our quest for learning more and spreading knowledge. Thanks a lot. Thank you.
Thank you,
Raju,
Rajiv. Thanks very much.
Thank
PPT.
you. Bye.
Raju, one small
Yeah,
request. Can you
yeah, yeah,
share this PPT to group?
yeah, yeah. I'll do that. I'll do that.
Yeah. Okay.
Yeah.
Thank you.
Thank you.